My first piece of advice to folks is like, don't let the tail wag the dog. Don't get into a bad deal just because you wanted to avoid taxes.
What's been the biggest frustration that you've seen or you've experienced with yourself or your clients when it comes to 1031 exchanges or lack thereof options for folks who are selling highly appreciated assets that maybe want to invest in multifamily deals with you and or when you're exiting deals?
Sure. So just speaking of 1031 exchanges specifically, I mean, I think the hardest thing with the 1031 exchange is the timing. And I get a lot of questions. I get a lot of questions about that. People come in and saying, "Hey, I got this 1031. Is there something I could invest in?" My first piece of advice to folks is like, don't let the tail wag the dog. Don't get into a bad deal just because you wanted to avoid taxes. I mean, especially we're probably in the lowest tax environment that we'll be in for quite a long time. Sometimes it's better just to pay those taxes and move on than put yourself in a bad deal just because your 45 days or whatever was running out. But I think that I think that one is just the timing and trying to fit the pieces together, right? I think two, a lot of people ask, can I invest in a syndication with my 1031? I think there's sometimes a misconception that you can, and you can't direct. Like a 1031 is a like kind exchange, right? So it's like if you're selling real estate, you need to buy real estate. Investing in a syndication doesn't quite get you there. You can with a tenant in common structure, but it's just it can be a little more difficult to set up. It's absolutely doable. I mean, my answer for folks is typically, if it's a larger dollar amount and it's a meaningful amount of equity for me and my deal, I'll go jump through those extra hoops to make it work. But you can't just easily get into a syndication and go passive through a 1031, in my experience.
Yeah. And do you have any like horror stories where like someone calls you and it's like, it's day 46, or maybe it's on the other side. You're like the seller and you're like, hey, oh, they've got just 4 days to identify. Oh, wow. Well, in that case, my counter offer is X. Like, any other thoughts around that 1031, shotgun wedding, got to get engaged in 45 days, married in 180?
Well, I mean, as far as negotiations go, I mean, just the more information you can understand about the sellers or the buyer's position, then you can use that information to your advantage, right? I
Mm-hmm.
mean, that's so obviously you would want to factor those things into account as you set your price. Um, as far as I get asked all the time by folks, or maybe folks through Bigger Pockets or other forums, saying, hey, I've got 2 weeks left to identify. Are you aware of any properties? And that's when I give that advice. Like, look, you're probably not in a position, if you're in California or somewhere, to come to Indiana and invest and make that successful in this type of hurry. In that environment, it may just be good to just, pay those taxes and move on. What I do tell people is, you can effectively reduce a lot of those capital gains without a 1031 by just buying or investing in another passive asset in the same calendar year that you're selling. So in our syndications, we do what's called a cost segregation, where we're breaking down the components of the property into their specific elements. So for example, a multifamily property depreciates at 27 and a half year schedule, just flatlined. So that's one way to approach it. If you do a cost segregation, you actually break the components of the property down, right? For example, the carpet in the apartment, how much is that worth? And that carpet depreciates at, I don't remember, it's either a 5 or a 7 year schedule. So it's a much more accelerated depreciation schedule, right? And because of bonus depreciation, you can actually accelerate all of that 15 and less year depreciation up to year one. And so typically in an investment, when we're doing a cost seg, which is almost every investment, we're able to offset anywhere. Like if you're investing for round numbers, $100,000, we're typically giving you about $60,000 to $70,000 in depreciation in that first year. That again can offset other passive gains that you have, and so you can achieve the same goal of saving on taxes, sometimes with avoiding that whole 1031 roll around.
Yeah, I couldn't agree with you more, right? Having cost seg and being able to get new depreciation schedules and invest in assets that have that is an advantage. So a couple thoughts on that, right? So one, we call it the shotgun wedding, right? We couldn't agree with you more, Kent, in that you don't want to let the tax tail wag the investment dog, right? And in fact, that's part of why I started Capital Gains Tax Solutions. I was at Marcus Millichap in 2006. Things were going great. Everyone loved to be a 1031 exchange, a seller. But as soon as they were a buyer, a lot of them were overpaying. And then all of a sudden, when the music stopped, someone had too much debt, not enough liquidity, not enough diversification. And I had one particular gentleman we were speaking with, and we were telling him, sell, sell, sell. Everything's at the peak. He didn't sell. He had $50 million in multifamily investments. He was leveraged pretty high. He lost everything. Within a 3-year period, everything was gone, went bankrupt. And part of it is because he was doing this 1031, just roll it, roll it, roll it. And he put himself in too much leverage, and then he lost it all. And we said, there's got to be a better way. And then we figured out a better way, and it was called the Deferred Sales Trust. And it actually enables you to sell high and buy low whenever you want to, not using a 1031 exchange. And we call it the Netflix way of doing things. It can save a failed 1031 exchange. It works for cryptocurrency. It works for primary homes. In fact, we partner with and work with other syndicators that are having assets and opportunities to invest in. And it's cool is because it's not IRC 453. You're not tied to that 45-day sprint and that 180-day close. It's IRC 453, which is an installment sale type of method. And so it's now available. By the way, if anyone wants to learn about that, they can go to capitalgainstaxsolutions.com. We're closing about a deal a week, and it's transformational for people, especially if they want to get to the passive side and they don't want to be so active, and especially if they have cryptocurrency and they're wanting to get into a real estate investing. You can check it out at capitalgainstaxsolutions.com. But that being said, Kent, as you're doing deals, when you exit finally and you've depreciated that asset, right, and you've done that cost seg, guess what? All of that recapture and all of that tax is going to be flooded in and you're going to get hit. So what is the exit plan when you go to exit your syndications to defer the tax?
Well, the best exit plan is to have something else to invest in, right? I mean, you continue to roll that money forward. And I think that's kind of the simplest answer. I mean, I love to be able to exit a property. We just sold a property here in June. Property I had down in Atlanta is a great return, about 25 IRR back to our investors, and have another property ready to go for them to invest right back in.
Got it. But the tax is paid at that point. And that's where most people find us, and then they figure out how to do this, and it changes things. But right now what you're saying is you're just selling and everyone's just paying the tax, but then you're trying to get another deal with a new depreciation schedule to do that cost seg and maybe wipe it out. Is that the strategy right now?
That is the strategy. You seem to have another option. Please do tell.
Yeah. So that is the Deferred Sales Trust, right? So I'll give you just kind of two deal stories, right? And that deal story is a gentleman, like you guys, there's two guys named Dave and Jordan, they're clients of mine. A $20 million multifamily asset. They're the two GPs and lots of LPs, and they're selling it in Las Vegas. And they sold and were able to put their GP positions. The whole entity doesn't have to move. It's very flexible. They deferred all of their capital gains tax. If the other investors are smaller, they just pay their tax like they normally would. But the Deferred Sales Trust allows total flexibility for partnership separations. Then they did another deal, $16 million multifamily property in Phoenix. Same thing, rolled those funds into the trust. Then they kind of have this I call it the war chest, right? Where the money is tax deferred, it's liquid, it's available. Then they can partner with the trust and they went and bought a multifamily property in Dallas. And so instead of paying that 30 to 50% in depreciation, recapture, and capital gains tax, you're able to defer it, but have no timing restrictions, have total flexibility, be able to get out of debt, no like kind debt replacement requirements. We got to be careful with mortgage over basis, which in that scenario, we're doing a partial Delaware statutory trust to take care of that debt over basis issue. And sometimes we even have clients do partial 1031s, right? Because 1031s are great if you can find a deal that makes sense. But let's say you're selling 100 units for $10 million and you find the perfect $6 million deal, or at 60 units, just to keep it simple. Well, there's $4 million of boot. Why not do a partial 1031 exchange and then the other partial deferred sales trust, right? So you can have a little bit of both. The key is defining what your tax liability is. 2, figuring out a good outcome of what you're trying to achieve. And then 3, executing on the plan, right? But you got to do this all in advance. And so, yeah, it's called a deferred sales trust. We think it's the best kept secret. A lot of people get it confused with the Delaware statutory trust. But yeah, any thoughts on that?
I mean, I don't know much about it, but it sounds like it could be a good option. Definitely interested in learning more.
Cool.